introduction. I may need to bottle you up and take it on the road elsewhere. When I spoke virtually with you at last year's Inclusiv conference, I was seated in front of a camera in my kitchen. So I can't tell you how pleased I am to be joining you here in person this year in Puerto Rico and San Juan in particular. We all know that community development, low-income designated, and MDI credit unions have worked tirelessly for decades to serve low to moderate income communities throughout our country. And there is no doubt that the COVID-19 pandemic has put that commitment to the test, just as the pandemic has tested every facet of our professional and personal lives. But the pandemic and its economic fallout have also shined a well-deserved spotlight on these institutions, which were providing relief funds to those who needed it the most at the time they needed it the most. The NCUA, of course, is charged with protecting the system of cooperative credit and its member owners through effective chartering, supervision, regulation, and insurance. That is what the NCUA does. But why we do it is to protect consumer members, promote their financial well-being, and to strengthen communities. So I sometimes like to think of the role of the NCUA as helping credit unions to help their communities and supporting institutions like those of you in this room that do a remarkable job of assisting and serving their members, especially those of modest means. To that end, one of our most successful programs and initiatives has been the Community Development Revolving Loan Fund. The grants that the NCUA makes through the Revolving Loan Fund make a real difference. These investments go into communities that would otherwise have unmet needs, giving credit unions additional resources to build their capacity and create more secure financial futures for their members. During 2021 alone, the NCUA awarded CDRLF grants to more than 100 low-income credit unions, including 22 grants totaling more than $1 million for expanding credit union outreach to underserved communities and improving their members' financial well-being. Advancing economic equity and justice is a priority for the NCUA, and these congressionally granted funds have facilitated our ability to achieve that objective. For this year's cycle, the NCUA will award more than $1.5 million in grants for small credit union mentoring, training, and leadership development, in addition to underserved outreach and digital services. The grant round opened on May the 2nd, and it closes on June the 24th. We really do encourage all eligible low-income credit unions to apply, and we are actually hopeful that we're going to be able to grow the program in 2023. The President's budget to Congress requested $4 million for the Revolving Loan Fund in the year ahead. That's more than the double that we got this year. That amount would help us make more funds available and make more grants available, make larger grants available, and to cover more ground and initiatives to assist low-income credit unions in fulfilling their very important missions. There are also other resources across the federal government to credit unions that serve low-income communities, including communities of color. For the example, the NCUA has strongly encouraged eligible credit unions to apply for the Emergency Capital Investment Program, or ECIP for short, because these institutions are really uniquely positioned to serve the communities the ECIP was created to help. The ECIP aligns closely with the credit union's mission to expand access to affordable financial services, free of discrimination, to those of modest means. Last December, the Treasury Department announced that 85 credit unions had received ECIP funding, and that was more than $2 billion in ECIP funding. The amount of these individual grant allocations ranged from $1 million to more than $200 million. The NCUA board then finalized a rule in December of 2021 that permitted this ECIP assistance to be considered grandfathered secondary capital under our old rule, irrespective of the date of the actual issuance, and that rule became effective at the start of this year. To further support this historic effort, the NCUA issued a supervisory letter to credit unions in October, permitting low-income credit unions that had the designation to issue 30-year notes under the ESIP. And later this year, we will be taking the third step, and this is probably the most important step, and that is actually changing our rules from saying that there can only be a 20-year maximum for this amount of money to being a 30-year maximum. We cannot underestimate the multiplier effect, and when we did our change in rules, we did not know that such a wonderful program like ESIP was going to come down the line. And we know that that money gets built up over 15 years, will be able to be multiplied many more times if we allow it to go to 30 years. And I'm eager to get this done, and Cathie, you have my full commitment that we will get this done this year. An important part of ESIP is preserving minority depository institutions, or MDIs. The NCUA is fully committed to supporting MDIs by providing these community institutions with needed resources like training, grants, loans, technical assistance, and mentoring opportunities. During the pandemic, MDIs increased membership and lending. They also expanded services to underserved communities and consumers. In 2021, the NCUA received 298 grant and loan applications, including applications for technical assistance grants for digital services and cybersecurity, underserved outreach, and MDI mentoring. And altogether, those grants totaled $4.7 million. Now, as I said, we could only get $1.5 million out last year, but we're looking to increase that in the future. And of the grants that we gave, 3 in 10 were to low-income credit unions that were MDIs. And later this year, we will have our DEI Summit. Miguel Palenko spoke with you yesterday. One of the things I'm excited about our Diversity, Equity, Inclusion Summit this year is we recognize the synergies that can happen between talking about DEI issues with MDI. So we are going to have an MDI track as part of the conference. And I think it's really going to be a great opportunity for us to come together and talk about both issues and even achieve something new and something better. We look forward to seeing you November 2nd and 3rd. We're still settling on the venue, but it will be in the greater Washington, Baltimore area. The relief that the NCUA provided during the last 2 years, of course, has come none too soon for many of you. The pandemic has accelerated shifts in the way credit unions conduct business, with more members moving to digital platforms and mobile apps to conduct transactions. The pandemic also further exposed the extent of disparities of wealth and economic opportunity for communities of color, underserved areas, and rural places. That is why the NCUA sought to improve its MDI mentoring and support to help the low-income credit unions and community development credit unions during the last 26 months. In doing so, we are remaining true to Roberto Clemente's motto. To quote the words of this very famous Puerto Rican baseball legend, if you have a chance to help others and fail to do so, you are wasting your time on this earth. I could not agree more. During the last 2 years, I've also learned that we don't have to settle for merely returning to the way things used to be. Moving forward, credit unions will share common concerns like cybersecurity, consumer compliance, field of membership considerations, but there are also concerns about disproportionately affecting communities of color and low-income communities. Those include overdraft programs and, as you discussed earlier today, climate-related financial risk. The pandemic has underscored for me that there's a lot of progress that can be made by us working together, the NCUA and the leaders of the credit union system, to make important and positive changes that will make the industry and the members it serves financially stronger. That work is good for our economy, and building more stable futures for more Americans will strengthen our democracy. Ultimately, the credit union system is really so much more than the sum of its parts. Just as the strength of any credit union is its members, the strength of the credit union system is in its collective unity. Instead of going back to the way things were, I want us to chart a process going forward about where things should be. In closing, community development, low-income, and MDI credit unions are vital to this effort of guaranteeing financial inclusion. At the end of 2021, we had more than 2,600 federally insured low-income credit unions. That's more than half of all federally insured credit unions. And those credit unions served members throughout the United States, Puerto Rico, Guam, the Virgin Islands, and on military bases around the world. Community development, low-income, and MDI credit unions are more than just a port in the COVID-19 pandemic storm. They are a lifeline to consumers who are historically underserved during the best of times. I am a firm believer in the mission of meeting the credit and savings needs of members, especially those with modest means. And as Chris noted, not only did my dad help to start a credit union back in 1967, but my mom is the secret shopper for her credit union to this day. And so I come at this knowing the importance of seeing how cooperative credit works and what it does. And our relationships have been tested and strengthened during the pandemic, and it will steer the credit union system and its members forward through future crises. In closing, community development, low-income, and MDI credit unions have not only endured, they have persevered and excelled during the last 2 years. And we at the NCUA are committed to maintaining and building that momentum going forward, including working with Inclusiv. Thank you for inviting me, and Cathie, I'm really looking forward to our conversation.
Thank you, Chairman Harper. Fabulous remarks.
Can you do me a favor, Cathie?
Yes.
I'm Todd.
Todd.
I think
We got that.
sometimes we put up these titles and it creates walls, and I want us to have a conversation one or other. Don't want us to be seated on different platforms.
Excellent. Thank you, Todd. And I think that deserves a round of applause. Just agency is going to want to be as accessible. And luckily today we have two regulators who are incredibly approachable and accessible and hardworking. And I think it's because you both came from the agencies as staff members that you're now leading. So this is a bit off script, but maybe we should hear a little bit about what does that feel like?
Well, first of all, let me point out, Mabel, it's been a delight talking with you over these last 2 days, and we're going to be working on a memorandum of understanding between the two agencies. It's going to increase access to training for examiners here in Puerto Rico for the cooperativas. It's going to also allow us to help COSEC better understand how we've applied secondary capital and maybe make some changes here that will not only benefit the cooperativas, but also help to learn from some of our mistakes along the way on secondary capital. And I think that's important that we learn back and forth. And in terms of answering your question more directly, having grown up within the system, first of all, you know the DNA, you know the characters, you know who plays what roles in the agency, but you also have a better understanding coming up within the organization of where things need to be emphasized more, what needs to be changed. And that really gave me a leg up in coming into the agency, having spent more than 6 years working internally within it, and allowed me to hit the ground running from day one.
Thank you. It's been noted, and I think there have been some moments in which we've had to reach out in a crisis and say, it's going in a direction we don't know it's the right direction, and having somebody who can help us immediately engage to start hopefully course correcting.
Well, Ndis is just an absolute example on that. When the Treasury was first conceiving the program, they said it was going to be a 15-year program. And 15 years was great because our regs said 20 years was the maximum term that you could accept capital for. And then Treasury switched gears, I think in a very positive way, to move to 30 years after talking with the sponsors on the Hill of this legislation that became law. And we needed to adjust. And Cathie, one of the things I really want to thank people like you and Bill Bynum and many others. When you flagged it, I called you up and I said, don't jump and don't scream too loud. We're working on it. Just give me a few weeks and we'll work our way through it. But it was the magic of you helping to make us aware that we needed to fix the 30-year problem. We fixed it in part. We're going to fix it in full. That allowed the conversation to continue and do it in a way that was productive as opposed to destructive for us.
Thank you. And that is huge. And it's a wonderful announcement to be making here, is to have everybody who is getting ESIP dollars have the confidence that they can accept that full 30-year term. And I think so many of the folks actually in the audience, delivered their analyses of what that impact differential was going to be if it was 15-year money versus 30-year money, and it really was astounding. So we were so appreciative. And speaking of that, I mean, in January 2022, we are grateful that as the new subordinated debt rules were coming in, you all were able to quickly exempt the ESIP dollars from the new subordinated debt rules. But now we're in a little bit of a new world where we have, at least with Inclusiv, and for those of our members who have been actively using secondary capital to fuel their growth, we're kind of navigating a whole new set of rules because secondary capital has been brought into a broader rule under what's called subordinated debt. And there's implications, the subordinated debt rule will apply to all credit unions in different ways. But by bringing secondary capital underneath that subordinated debt rule, we're finding that we're kind of relearning some systems. We're designing, and yesterday we gave an award to our attorneys. We have a pro bono law firm, Millbank, and at our award ceremony yesterday, celebrating the fabulous Annie Vamper award winners, we gave an award to Millbank because they were the law firm that helped us redesign all of our closing documents to be in compliance with the new subordinated debt rule. I will not tell you how many hundreds of thousands of dollars of pro bono law service, firm dollars that they saved us on that. But we're kind of relearning this new subordinated debt rule, and I think some of which has been not as frightening as we thought it was going to be at first, and then some of it remains challenging. So I wonder if you could tell us, if not in specifics, but maybe in terms of process, how you envision we can be working together over the next year to be ensuring that if there are fixes that need to be done to the rule, that we know how to do that and how to raise that up and get those fixes accomplished.
So, Cathie, first of all, let me just do a little education here on the subordinated debt rule. And as we were looking, secondary capital has long been used within the credit union system and has long counted as capital, and that's where the Inclusiv members have long applied it and used it. There's also a piece of the Federal Credit Union Act that says that for complex credit unions, they can use subordinated debt to also count as capital for their risk-based capital rule purposes. And we had the risk-based capital rule that also came into effect at the start of this year. And as we started to dig deeper and look at what secondary capital was and how it was treated, we realized that it was debt that needed to have a certain amount of transparency attached to it. I know that you and I, Cathie, and a few others had some regular discussions as the rule was going both through the proposed rule process and the final rule process. And I asked at the board table, both at the proposed rule and at the final rule, I wanted to make sure that low-income credit unions that wanted to get secondary capital would not be disadvantaged. And where we came down into it, the agency and staff assured me there would be a learning curve, as we worked to provide the disclosures that needed to be there, but that once we got those templates in place, they could be used for many bilateral agreements. And that's really an important thing to note about what is happening with secondary capital low-income credit unions. It is usually that bilateral agreement, and that doesn't require as much disclosure as you would if you had many parties, which is where larger credit unions that are using this capital account towards the risk-based capital ratio are doing. And I know that you've been gracious enough to share the documents that your lawyers developed and put in place, and we've certainly been taking a look at them to make sure that they're hitting everything. And we're going to continue that dialogue over the next year. So again, this kind of becomes just sort of standard forms that any credit union can pick up and use for the bilateral purposes. But as you get more complex, we're going to expect greater depth along the way.
That's very good to hear. And I will say the team at NCUA has been incredibly open to reviewing all of our templates and and going through that. We're still in process, but we feel like we're pretty far along to having a completed set of documents. I think this is really important for everybody in the room who is, particularly smaller credit unions, but really most of our credit unions who are not doing these complex, borrowing activities. They're just trying to have one, bilateral loan agreements with lenders. It might be Inclusiv, it might be a local foundation in your community, it could be a local bank that wants to support your work. We do have those documents, and as soon as we get the sort of, everything signed off on, that is available to Inclusiv members, because it's important that this not be stopping the flow of capital when we need it most.
And also to a real differentiation between Inclusiv members getting this capital versus larger credit unions. You're not going to have to go through the rating agency process. You're not going to have multiple players looking in and leaving that window into the world. Again, one of my approaches is looking at the NCUA regulation is looking at scalability. And we need to treat the smaller credit unions to help them, because they have many more hurdles and burdens to overcome, and we need to be flexible with how we approach regulation and supervision there, and we're certainly doing that here with the secondary capital.
Thank you for that. I'm going to switch gears a little bit, although to your sort of second point, or maybe it was your first point in your remarks, around MDIs. And I know that here at this conference with Inclusiv, our allies in the movement, and our DEI collective work, there's a real fabulous moment going on in the credit union industry that is really looking at diversity, equity, and inclusion, and thinking through and really baking that into everything we do in the credit union industry. We know that the greatest source of our diversity in our movement are MDI credit unions. And we have this incredible legacy of credit unions, minority designated credit unions. You have a great process for institutions to very easily get designated and self-certify as MDIs, and very clear criteria. And with over 500 MDIs in our movement, it is a huge part of who we are and what we do.
It's 1 in 10.
1 in 10.
Which is, if you think about it, it's remarkable, particularly when you look at other types of financial institutions charters. None comes as close as to where credit unions are.
And that is something we need to preserve and grow and build. We do also know that the vast majority of MDIs are under $100 million in assets. Sometimes they may have exams where examiners come in and say, you're too small, are you relevant anymore? You need to start looking at merge partners, right? And so, and that's sort of one example. There's also a number of examples in which examiners come in and say, how can we help? What can we do? So, but I do want to sort of, you mentioned you're going to have a very specific focus with the Community Development Revolving Loan Fund on making sure that those funds are really being targeted to MDIs. I wonder if you could tell us what else could we be seeing coming out from NCUA that is really kind of going to work with us to make sure we keep that solid 10% and move from even growing that.
So, boy, there's a lot to unpack in that question. And you're right. I love MDIs and what they do because they are making loans that otherwise would probably be unmet credit needs, and they are providing floors for families and individuals to continue to do well, and that they don't fall into a trap. What can we do with MDIs? We can do a lot of things. First of all, when I talk about the revolving loan fund money, and by the way, CDRLF are the 5 hardest consonants to say together. When I talk about the revolving loan fund money, we're growing the mentorship program. We recognize that for these partnerships to come together, sometimes they need a little juice, if you will. And if we can provide that money related to travel, related to training, related to other things that allow that mentorship to occur, we want to encourage that to occur. Second, I learned when I became chairman of the Federal Financial Institutions Examination Council, and for those who may not know, the FFIEC is all of the banking agencies coming together. So it's the NCUA, it's the FDIC, it's the Federal Reserve, it's the OCC, it's the CFPB, and there's also a state liaison committee representative on there. And one of the things when I became chairman, I said our focus over the next 2 years would be on economic equity and justice. And the first thing, Cathie, that I asked was the task force on supervision to do was to go and take a look at how we examined minority depository institutions. And I had an eye-opening moment. That eye-opening moment was when they came back to me and they said that none of the other federal banking regulators used pure metrics when it came to MDIs. The NCUA was the one alone that did. And suddenly my brain clicked, and it was when I talk to MDIs, they often get dinged on their examinations because they may have higher expense ratios. Well, that could be because of who they are and working with their members, and they need more one-on-one support. And so we are looking internally as to what we can do to change the exam process when it comes to MDIs, so that we are looking at the unique nature of them alone and not comparing them to uncomparable peer metrics. I think that can make a real change.
Yes, it can.
And then, one other thing that we can do, it will take Congress to do it, but certainly finding a way to get more money to flow to MDIs. Right now, only MDIs that are low income can receive grants and support. We're looking to do more there. As I said earlier, Miguel Palenko, who heads our Office of Minority and Women Inclusion, we're going to be having the joint track of MDI/DEI summit later this fall. We can continue on the training and support there. We're also growing out our support in the regions for MDI support hours. This is one of my favorite moments of being chairman. It's the ability to affect and influence the budget. And as part of this year's budgets, we have given all of the regions hours to be supporting MDIs and low-income credit unions. And I think it's about 2,600 hours per each of our regions. And what I've challenged is, let us know if we need to do more there, so that as we go into 2023, we can make those budget decisions in order to make changes there.
That is fabulous. Because the combination of the access to grants and the ability to invest in, whether it's upgrading your technology or what have you, but the ability to have your contact folks at NCUA understand your business model. It's just invaluable. So thank you for doing that. I will also say I will make a pledge that Inclusiv, we do every year an analysis of CDFI performance, and we compare that across the credit union industry, and it does help to show a different way to understand the business model. So while we may have higher operational costs, while sometimes the delinquency may look a little bit higher, in general, CDFI credit unions and MDI credit unions are at par when it comes to charge-offs, and oftentimes when it comes to earnings, they're actually ahead of the game because they are deploying their assets, they are lending.
Well, Cathie, you all, after the last financial crisis, did a remarkable study that showed that those credit unions that leaned in and lent out money to borrowers during and in the immediate aftermath, and we're talking MDIs here, we're also talking low-income credit unions here, actually recovered more quickly. And I think that's an important lesson for us all to learn. Certainly, I don't think a day goes by where I don't remind credit unions work with their members during difficult times. Why? Because they're going to become loyal to you, and that loyalty is going to pay dividends in the years to come in terms of where they borrow and how much they borrow, and that's going to help the credit unions bottom line.
And that is the ultimate financial first responder, right? That they, by mission, you should do it, but also knowing that it's a fit for the business case of it. And I'm glad you bring that up because it does give us an opportunity to maybe segue our conversation back to the conversation from our first speaker this morning, Shalonda Baker. And a lot of the work that Shalonda Baker is doing in this intersection of energy policy and climate action with social justice. And you play an important role on the Financial Stability Oversight Committee. And there's, as I understand it, there's going to be a need for regulators to be coming up with kind of understanding the new climate risk framework. And I think the ability to recognize the importance of leaning in during crisis, because more and more of our communities are going to be experiencing crises of one form or another, and seeing that as the virtue and not the risk will be so very important. So I wonder if you have thoughts about how to sort of pull some of those lessons into that bigger conversation around climate risk.
Climate financial risk is certainly fully understood here in Puerto Rico. Mabel talked about it during her remarks about the hurricanes. The data shows that the frequency and the size of billion-dollar events is growing. Back in 2020, if I'm remembering the numbers correctly, we had about $22 billion events, and that's everything from hurricanes to wildfires to drought. And that was about $95 billion. Last year we had 20 events that bound to, but instead of 95, it was $145 billion in losses to credit unions. Cathie, few people remember, but we also lost 2 credit unions after Hurricane Katrina that just didn't have the resiliency built into them. And we as an agency have to be thinking about risk. That's what we do. We help credit unions to think about risk so that they can plan for that. Those risks can be so much. It can be a changing environment. And what do you do if you have that changing environment, and how do you need to perhaps change your field of membership to change that changing environment? Or, we have a lot of credit unions that are single employer credit unions. What if that employer needs to diversify or there are issues there? So what we can help credit unions to do is identify what those risks are so that they can begin taking the steps to ensuring that they will be around not just 5 years from now, but 10 years from now and 50 years from now. As an individual, small credit unions for me are at the heart of the movement. And we need to do what we can to help ensure that they are there tomorrow. And that's what I'm constantly thinking about what we're doing. We can facilitate that by not only how we conduct our supervision, we can also do things like changing our rules. One of the things that was a happy lesson that we picked up out of the pandemic is we passed a temporary rule that allowed credit unions to do more loan participations and more eligible obligations. And one of the things we found is that some credit unions were partnering with fintech providers to do solar loans, and that those solar loans were then being participated out and becoming eligible obligations also to go on to credit unions' books. But one of the things we also found is those were 25-year loans typically, which exceeded the 15-year cap. And we're now looking at how can we take down and knock down this temporary rule that we put in place, but learn from it so that we can allow that sort of lending to go forward, which will really help communities of all types get out there and do more lending in this area, which I think is highly important.
That's going to be a very important new direction for us to explore, because we would absolutely love to see that ability to do longer term solar loans. As so many folks in the room will know, because they've gone through the solar finance training programs and they've designed their own lending products, when you design a solar loan or an energy efficiency loan, but a loan that's about, helping a lower income household be able to afford solar. So that seeding that Shalonda Baker talked about, how do we seed this in communities of color? Well, or in low income communities, what we know is that you do have to match those loan repayments to the energy cost benefits they're going to get, because there's just too much pressure on the household budget to be able to take on this next idea of, like, I know it's good for the environment, I know I would like to have solar panels and maybe it'll help me be more resilient in power outages, but I have too much demands on my household budget right now, I simply can't do it. When we can show that the loan repayment is going to be less than what their cost savings are for the utility payments, that makes it affordable. And sometimes the way to do that is to lengthen the loan term and go beyond that 15 years. So we will certainly see that as a great opportunity to make sure we're getting these products as equitable as possible. So thank you for that. And
Happy to do that.
however we can weigh in. I know there's going to probably be a number of folks in the room who will volunteer if there's any advisory or engagement you want to do around that. I know there's probably a lot of folks who'd love to do that. I think, do I have time for one more question?
We are yeah, of course.
Okay, one more question, because, and this is a little bit switching gears from the climate and the risk framework. And this is talking a little bit about small business lending. And as you know, the credit union movement stepped up incredibly during the pandemic and became really, I think, the savior story of getting Paycheck Protection Program loans out into communities and to businesses that were being completely overlooked by the mainstream banking industry. And now we have all these fabulous relationships with businesses in our communities. But there's a real need for us to figure out how to make systems work to help credit unions be able to continue to provide loans to those businesses. Sometimes that's going to be, are there loan loss reserve opportunities? Are there loan guarantee opportunities? Can we make SBA more user-friendly? Can we think about this State Small Business Credit Initiative, SSBCI, that our speaker yesterday, Janice Bodler, mentioned that coming out of Treasury. How can we work with NCUA, or how can NCUA help us? And I know you're very incredibly skillful at connecting with other government agencies. How can we go about making some government programs more useful and user-friendly for credit unions that want to do more in the small business lending space?
So, Cathie, to flesh out the first part of what you were speaking about, I think it's really important to take a look at where the Paycheck Protection Program loans went to. And our economists did an analysis and looked at credit unions and looked at banks and where the loans were. And the number one loan type or business type for both banks and credit unions, I actually should say credit unions and banks, was restaurants. Now, not a real surprise, but as you went a little deeper, there were some surprises. For credit unions, they ended up helping the contractor professionals. They were the HVAC, the air conditioning, the heating, the plumbers. We had a very large number of banks on the flip side, law firms and doctors' offices is where they were a little bit. Also, credit unions did an incredible amount with respect to nonprofits, probably because they understand the not-for-profit business model, and there was a real need there where they stepped up and they started to form new relationships which they want to build. I do want to say something also remarkable about credit unions and PPP loans. I've often asked audiences, what is the smallest PPP loan that their credit union made? And I have a number that are in the $600 range. And if you think about the 5% fee, that credit union made $30 on underwriting that $600. But that $600 made the difference for somebody from probably being able to eat to not being able to pay their utility bill to not pay their utility bill. The smallest one, however, Cathie, that I know is $180, which is just boggles the mind at a certain time. What can we do going forward? Well, first of all, I have been a long-time advocate for lifting the member business lending cap. We know that small credit unions need to reach economies of scale, and at the current 12.25% cap that is statutorily imposed, it becomes too hard for a credit union of $50 million to really justify having a full-time business lending expertise on staff. And so that is certainly one way that if you can figure out, I have testified before Congress on it, but if you know of ways that you could lift the cap, I think that could make a huge difference in this space. Second, I have often said that credit unions have a moral obligation to helping communities of color and people of color recover from the catastrophe that we've known as these last two plus years. And another statistic that I find absolutely frightening is that in the initial months of the pandemic, we saw about a 20% drop in the number of small businesses. So 1 in 5 closed their doors. For white-owned small businesses, it was 17%. For, and I don't remember all the numbers, for Asian-owned businesses, it was in the low 20s. For Hispanic-owned businesses, it was in the 30s. But for Black-owned businesses, more than 40% have closed their doors. There are 3 ways to build wealth in this country. The first is opening and funding an IRA savings account for your retirement. It's not open to everybody as that opportunity has it. Only if their employer really offers it, or if they make enough income in order to set aside that money. The second way in which you can build wealth in this country is to buy your own home and build up the equity in that. And Cathie, we can go on about appraisal issues, which is another issue for another, next conference we'll talk about that. But the third way is to start a small business. And I want credit unions to be out there because prudently underwritten business loans to members can actually diversify the portfolio, produce a good income stream for the credit union. And we're going to continue to be within the agency better educating our staff, examiners, about why business lending is a good thing. I recognize that we've got some issues that we have to do and continue to do to educate there, and we will continue to educate there. But also just supporting credit union efforts overall.
Thank you. That is wonderful news, and I think that examiner education will be huge, in addition to the lifting of the cap. So I want to just thank you, Todd, for being here with us this morning and for being with us in really for the full conference. And I know so many folks here just are, it means a lot when that you take the time always and you're so accessible and available to come talk to us. So we really appreciate it. It's certainly not the end of it. Our conversations, we'll have many more even this year, but thank you for taking the time.
My pleasure.
All right.